Before you borrow from yourself by taking out a 401k loan today, I'm going with top 3 pros as well as top 3 cons that you should be aware of. I'm not here to tell you whether you should or should not borrow. I'm just here telling you, showing you the information so that you can make an informed decision based on your personal circumstance. For me personally, I have taken not once, not twice, but 3 401k loans. The first 2 401k loans was in my 20s and early 30s to support my lavish lifestyle. YOLO mindset. You only live once. Consumer mindset. But my third 401k loan was for a valid reason. I wanted to make sure I have a 20% down on my current house, and I wanted to bridge that gap. I think I was short about $10,000 then. So I borrowed from my 401k loan to ensure that my mortgage doesn't have PMI, private mortgage insurance. Looking back, it's actually a pretty solid choice because my mortgage payment, principal plus interest, is only $785 per month. With the current housing affordability crisis, I am very fortunate to have a $785 per month mortgage payment. Now on to today's topic. The 401k loan, you are allowed to borrow up to 50% of the vested amount, or $50,000, whichever is less. So the first benefit, the first pros of borrowing for 401k is that it is convenient. You don't have to have a credit check to borrow from your 401k. And the second is when you borrow from 401k, you don't get hit with an early 10% withdrawal penalty, and the loan doesn't count toward as an income. The third benefit, the third pro, is that you are paying the interest to yourself, not to the bank, not to the plan provider. You're paying interest to you. But there's also a catch. The first con of borrowing from your 401k is that when you make your payment, you are paying it after tax, both principal and interest, which means your interest portion kind of count as a double taxation. Going in paying to yourself is tax, and then when you withdraw 59.5, the proceed will also be taxed then. The second con is the opportunistic cost. That borrow amount is no longer working hard for you in the stock market. And the third con is very important. When you lose your job, whether you quit, get fired, or switch job, you are required to pay the remaining balance in full. And if you could not pay the remaining balance in full, that remaining balance is count as a distribution, which means taken out from your 401k. And if you're under 59.5, you also get hit with a 10% penalty on top of paying ordinary income taxes on that distribution portion, that remaining loan balance. So in the next few minutes, I will go over how that works in terms of the amount being taxed and the penalty. This example is only showing the federal income tax level, and it is an average Midwest household income, married filing jointly with no kids. Their combined income, their gross income was just under $84,000, and these are the different pre-tax contribution. And the wage and W-2 combined in box 1 is $71,236. They have no other income and deduction, so their adjusted gross income is $71,000. With their standard deduction for married filing jointly for 2026 tax year, filing 2027, the standard deduction is $32,200. So that brings their taxable income to $39,036. So if I take this amount and put in my calculator, the estimator, their tax liability on just the income portion is $4,188. And you can see how the $4,188 was taxed at different tax rate depending on the taxable income where they fall under. In this example, when they lose their job, they still have $20,000 loan balance, and now that $20,000 become an income, a taxable income. The whole $20,000 is still taxed at 12% because 39 plus 20,000 is still 59,000, which is still in this 12% tax bracket. For that remaining $20,000 loan balance at 12% tax, that's $2,400 in tax liability. Plus the 10% early withdrawal of that 20,000, that's another 2,000. So the final taxable income is $59,000. If I put that here, the total tax liability is $6,588. Plus the $2,000 of early penalty, the final tax liability is $8,588. What that means is the remaining loan balance of $20,000 costs them an additional $4,400 in taxes plus penalty. That is 22% of the remaining loan balance. Another example is the comfortable Midwest household income, married, filing jointly with no kids. Their combined gross income is $134,000. Their wage on W-2 after many of the pre-tax contribution is $119,000. They have no other income and deduction, so that brings their AGI, adjusted gross income, to $119,000 minus a standard deduction for married filing jointly of $32,200, bring their taxable income to $86,938. If I take that amount and put it here, so their tax liability is $9,937. But if they have remaining loan balance of $20,000 that they cannot pay off, now counts as an early distribution. The first $13,861 is taxed at 12%, so that's a $1,600 of tax liability, and the remaining $6,138 is taxed at 22%. That's at $1,350 of tax liability. You notice here you have different amount. The first amount is taxed at 12%. The second amount is taxed at 22%. That's because $86,000 of the normal income plus that early distribution is $106,000, which means over $6,000 is beyond the 12% tax bracket. It is now taxed at 22% tax bracket, hence the 22% for the remaining $6,138 out of that $20,000 distribution. So if I put that amount in here, you see that's how they're being taxed based on where the taxable dollar amount fall within the bracket. And they still get hit with the 10% early withdrawal penalty of $2,000. So the final taxable income is $106,000, and the final tax liability plus the penalty is $14,950. What that means is the remaining loan balance of $20,000 costs them additional $5,000 in taxes plus penalty. That is 25% of the remaining loan balance. I like to bring up the tax calculator because it visually tells you how each taxable amount are taxed on a different tax bracket. And the reason I show that, very few people, when I see social media content, unfortunately, a lot of people are not familiar, don't have a full understanding how our progressive tax system works. Now you have the information you need to make an informed decision based on your circumstance. You know the 3 pros. It is convenient. It doesn't require any credit check. When you are borrowing from yourself, that doesn't count as your income, and you don't get charged with a 10% early withdrawal fee. And the third benefit is that when you do pay it back, you pay it back to yourself, both the principal and the interest. But the 3 cons is when you pay back, it is after tax dollar. What that means is the interest portion is kind of have a double taxation where it goes in already taxed, and when you withdraw at 15.5 or later, it is also being taxed as well. And the second con is the opportunistic cost. That total loan amount is now not working hard for you in the stock market. And the third con, when you lose your job, whether you get fired, you quit, or switch job, you are required to pay that remaining loan balance. And if you cannot pay off that remaining loan balance count as a distribution. And if you are younger than 59.5, you also get hit with a 10% early withdrawal penalty, plus the ordinary income tax on that early withdrawal distribution. Now, armed with that information, you can make an informed choices on whether that is a good choice for you or not.